Well, if markets are increasingly driven by flows rather than fundamentals, investing becomes a very different game. So how should investors respond? Well, in this segment, we look at whether these structural shifts are creating risk or opportunity and how value investors can position themselves in a market that may not always be thinking clearly. Joining me and Andrew on the desk is Angus Geddes, CEO of Fat Profits. Great to see you, Angus.
Good to be here.
So what type of investor are you? And tell us a bit more about Fat Profits.
So we are contrarian-based investors. We take a fundamental approach to sectors, stocks, markets that are pretty much out of favour. And we also use technical analysis to try and get a good sense of timing in terms of entry points and exit points. So Fat Profits has been going for 25 years. We started out as an independent research house, and we now also run a funds management business, and we have a listed hedge fund on the ASX, and we very much cater to retail investors, mums and dads, but also high net worth individuals.
And if markets are increasingly being driven by passive flows and algos, how do investors adapt?
Well, I think you've got to be a little bit careful about algos and passive investing, because sometimes trades can become quite crowded. And of course that sets the market up for a move in the opposite direction. So, we very much sort of look for uncrowded areas of the market and, some of the themes that have been a little bit more overlooked. So you won't find us sort of chasing the hottest thing in town. We tend to be sort of leaning in the other direction. But having said that, exchange traded funds, passive investing have a place. For example, we're thinking that uranium stocks are a good place to be looking, as is the gold sector at the moment. Nothing wrong with an exchange traded fund which can actually diversify a lot of that specific stock risk away.
Andrew, your take on algorithmic trading?
I mean, it's just supply and demand, right? I think what we're talking about here is flows of money as opposed to anything affecting how a long-term value investor would approach anything. I mean, the reality is still a wonderful business with strong moats and a good management team that's growing well, bought at a reasonable price is a wonderful investment, and missing any of those criteria, either not a wonderful business or not a wonderful price, is likely to end up a poor investment unless you happen to get very lucky and time it perfectly to get in and out, and I would say that's more luck than skill. I think where it comes down to with algorithms and flows of passive money is just simply that the weight of capital can really overtake one side of the equation of the ledger. In other words, you can get a huge amount more money in the buy column than you should based on theoretical fundamentals, or way more money in the sell column. And so rather than the market acting as a really good weighing mechanism, accurately valuing assets, it can overshoot materially and overshoot more than even human nature would sometimes overshoot it. Now, for a long-term investor, that's wonderful, because you don't have to buy when it overshoots high, you can sell, and you don't have to sell, you can buy when it overshoots under. On the other hand, if you're someone who either needs to move money really regularly, you're someone who has to go in and out of the market all the time, or you're someone who has to buy high, sell low because of your funds management mandate. Now, neither of us would be, but there are others out there that have to do that. Momentum strategies, for example. That's a really dangerous time, because it means that the swing may well be larger than you expect and faster than you expect, which of course to us doesn't matter, but to a lot of people does.
Angus, we're talking about how volatile markets are at the moment. It's been an extraordinary start to 2026. When you look at share prices in general, are they less reflective in your view of what we're seeing in underlying businesses in terms of value than they potentially used to be?
Look, they can overshoot. 4 weeks ago, before the advent of the Middle East war, the market was pretty buoyant. We saw pretty high valuations in the US. So they can overshoot on the top side, and then of course sentiment can change quite quickly. We've had the outbreak of the war. Sentiment skewed the other way. So I'd probably argue, value's almost sort of overshooting at the moment. Sentiment's sort of overplaying its hand.
What about you, Andrew? Do you think there's still opportunity for value investing?
Oh, huge amounts. But I don't think that's any different.
Yeah.
Maybe there's a few more now, but in general, there's always opportunity. There's always an advantage in being rational when everyone else is irrational, in general. I was actually thinking about this earlier, getting ready for the program, but I was on one of the monthly wrap-ups with you back in January, and you asked me what I thought my theme for 2026 would be. And I said I thought there'd be a snapping back of PEs, that we had a very bifurcated market. We had lots of companies at the big end of town trading on multiples that just their actual earnings didn't justify. And at the bottom end of town, a lot of companies trading on PE ratios that looked stupidly low. And I think all we've seen with the Iran crisis is people waking up one morning and going, why am I paying that? And then, geez, that one looks cheap. And they both flipped back to the middle. Now, in theory, we should have a market whose PE ratios are distributed like a Gaussian or bell curve. You know, most people around the mean around 20 times, a few extremes high and low reflective of the companies. We didn't have that in January. We had an inverse bell curve, a parabola, lots on really high multiples, lots on really low multiples. And all we've seen in the last few months is that crowding back towards the middle.
And you talk there as well about signs of an index effect. So companies sort of trading at a premium simply for being in the index. How do you kind of approach that?
Yeah, well, look, in theory, it shouldn't happen, right? I mean, in theory, being in or out of an index should have no impact whatsoever on the value of the asset. That's like just saying your home has more or less value because someone else includes it in a bucket they're measuring. That makes no rational sense. However, we have started to observe in academic literature the beginnings of this index effect occurring. And in fact, we find it in two things. Number one, Duffy did a paper, Duffy et al. In 2025, which actually showed that from an actual point of view in the US market, inclusion in an ETF creates a share price premium compared to the stock trading outside the ETF itself. In other words, if there are two stocks available in the market that are identical, the same company, you can buy it outside the index or in the index, inside the index, you pay more for buying the ETF holding the index than holding the stock itself. That's irrational. It can't be sustained forever. Potentially that's some of what we're seeing is the fall in some of the big end of town. And the other thing is I did some analysis back in October 2025, which I think there's a graph you may want to show, which showed that index premium in action for the ASX. And effectively it showed a 40% premium for being inside the 100, a 26% premium for being inside the 200, a 23% premium for being inside the 300 compared to the rest of the market excluding that. That is not sustainable. That means investors crowding in and paying more for every dollar of earnings simply because it's in a bucket I can measure than in reality that company deserves when it's out of that bucket. And it's no surprise that where have the biggest falls been in the market in the last few months when people, I think, have woken up and started acting a bit more rationally again? Well, in the companies with the biggest index premiums.
Angus, in your view, what does that mean for markets and whether or not it makes them harder to outperform here too?
Well, I think, as a contrarian investor, I think it actually makes it a bit easier for us because, by definition, you're looking for sort of uncrowded trades, uncrowded companies, stocks that are very much sort of outside perhaps the magnifying glass of a lot of fund managers. Take for example, CSL. It missed on earnings. It was quite crowded about a year ago. There were a lot of fund managers who thought it was cheap and that there was a value play to be had in that company. And then what we saw, of course, after they disappointed the market, the stock got dumped. And I guess this is where we sort of come into it. I think when you do get those sort of crowded trades and the market starts unloading on it, that's when something gets really interesting because, often a share price or a company will bottom out on bad news. And typically what we try to do is buy them when they're as under-owned by the broader market as possible. And by definition, that really means you want these types of companies to have a really small weighting in the benchmark. As we've seen with CSL, for example. I'm not saying we're buying CSL today, but you know what? You want sort of almost underrepresentation relative to the index, and then basically look for those sort of upside surprises. So it's when something's gone down that really attracts me. Something's been going down for a while. It starts bottoming out on bad news. It becomes really under-owned by the broader market, certainly the professional end of town. And then you'll get an upside surprise, which comes as a surprise catalyst, and all of a sudden, the stock's sort of back in the race. So, we continue to wait for that to happen for CSL. But those are the types of situations that we look for, rather than buying the hottest thing on the street, which is over-owned by definition, big chunk of the index. It's only going to go one way if there's any disappointment.
So to that point, Andrew, some of the best opportunities can be outside the index.
Yeah, I mean, absolutely. I don't think being in or outside an index makes any difference to whether the opportunity is good or bad, right? I think that the challenge we get caught up with as humans time and time again is we're herd creatures by good evolutionary reasons. It didn't make sense running away from the lion to run all in different directions. That just meant you all got eaten, right? So from that point of view, there's a big incentive for humans to want to be liked and want to crowd in together on the up and the down. But, that's a very silly investing strategy. It would be the equivalent of only going into a store when it's not on special. Saying, oh no, they're on sale today, I can't buy, I've got to wait for them to put the price back up. And yet that's what indexes do, right? They buy high, market caps rise, so they become a bigger proportion of the index, so more people throw their money in, and then they fall a bit, they go on special, and everyone goes, oh no, sell while it's low. So they become self-reinforcing as a very quick way of losing money. And Teaminvest, there's that lovely saying from the Odyssey, in the land of the blind, the one-eyed is king. And as a value investor, a Teaminvest or a Buffett-style investor, the more people are blind, the easier it is for you to make money, even if you're only one-eyed. So let alone if you know the company brilliantly, really inside your circle of competence, it becomes easier and easier just to make money because people are running around like lemmings. What the hell's going on? I'm an ex-cricketer, not necessarily a very good one, but my idol, of course, as most young Australian boys, batsmen growing up, was Donald Bradman, and he famously got asked, how did he average so much? And he said, you can't get out caught if you keep the ball on the ground. And it's the same thing as an investor. You can't get out caught losing big amounts of money if you keep the ball on the ground, if you buy wonderful companies without debt, with good management at low prices. Yes, there are periods you won't perform because other things will be more exciting and the flavour of the month. But in the long run, compounding and the power of that investment will far outweigh any FOMO in the short run.
Angus, you touched on CSL and the big move that we saw following a disappointing result, and that's sort of been very prevalent in the most recent February but also August reporting season with a number of some of these big companies that missed. Is that a sign the market's doing less fundamental work, do you think?
Probably baking in too much optimism. And I think, when we've been talking about crowded trades, when there's too many people on a company or a theme or a thematic, and they're all looking for a similar outcome, by definition, that sets, the market up for a nasty surprise. And you're right, we have seen quite a lot of dispersion in relation to that. But, what I've sort of found is that the less people are looking at something, and it might be sort of, a company might be going through a hard time or a market might be really out of favour. Doesn't really take much to turn it around. And it was interesting just hearing your analogy before, because I sort of liken it to ice skaters out on a rink. When the sun's out and everybody's out on the ice, does that necessarily make the ice safer or more dangerous? In the markets, it tends to be, people tend to think it's safer, but it's not. When there's one or two people out skating around on the ice, people think it's a safer environment. So, and I guess this sort of goes back to what we're saying about passive investing. Sometimes the uncrowded path, the uncrowded stock, the uncrowded market is often, a safer proposition at the end of the day.
So in your view, what's one practical change that investors could make to really, see movement driven by flows rather than fundamentals?
Well, I think, looking, if you sort of wake up and read the business press, the newspaper, and, everyone's in the market is talking about a particular sector, let's say lithium, it's starting to sort of head for the hills. I'd be on the lookout for really, really popular bulletproof type themes. I mean, it was only at the beginning of the year that, software stocks never went down. And, how the world's changed, in the last sort of 4 to 8 weeks. I actually think software's getting quite interesting now. So whatever's really topical, whatever's really in vogue, I would be counselling to look the other way and take a path that's less trodden.
What's one practical thought in your view, apart from watching Wealthy and Wise, Andrew?
Apart from watching Ausbiz and Wealthy and Wise. Look, being rational doesn't make you popular, it just makes you rich. So the question you have to decide if you're going to be an investor or playing in this game is, do you want to be popular or wealthy? If you want to be popular, read the AFR, do everything the AFR says, go into all the crowded trades, you'll be the life of the party and everyone will ask for your opinion. But you won't get good returns. In order to get good returns, keep your eyes open and stick to the basics. Keep the ball on the ground, as Bradman would have said. Buy good businesses that are profitable, that aren't loaded up with debt, that are run by people who are capable, ethical, and have skin in the game, and just pay a reasonable PE for them. We did an episode a couple of weeks ago about the fact that what is the most loved sector in the market one year is almost always the least loved the next. And I made the joke, the viewer question was, how do you feel when you've missed out on one of these trends? And my response was, wait 18 months. Because that's roughly how long these trends go. The thing that was up now, 18 months later, will be down, and the one that was down will be up. So if you buy good assets and then you're just, I was going to say patient, maybe the answer is lazy. You stay in them and you don't overthink it, the natural compounding effect of owning a good business at a reasonable price will make you very, very wealthy. If you want to dance in and out and try and pick the trends, you'll be popular, but you won't have money.